Right, good morning, shareholders. It's 10:30 and I think we should get started. Good morning and welcome to the Spheria Emerging Companies FY2020 full year results presentation. We'll refer quite a lot today to the company as SEC by its ASX ticker. My name is Chris Mayer and I am the Director of Listed Funds at Pinnacle Investment Management. Pinnacle is an equity partner of Spheria Asset Management, the manager of the SEC portfolio. Pinnacle handles all marketing and distribution servicing and shareholder servicing for SEC, and I will be the host of today's call. Joining us today is Jonathan Trollope, the chairman of the company. Jonathan, if you just want to wave your hand. There's Jonathan in his study at home. He'll provide an overview of the financial year, and he'll be followed by Marcus Burns and Matthew Booker, the portfolio managers and co-founders of Spheria Asset Management. They'll provide an update on the company's portfolio and give us an update on how they see the small cap market at the moment, particularly post the COVID crash in March. Matt and Marcus, you can see in the Pinnacle office over there. At the end, we'll take some questions from shareholders. For those of you who would like to ask a question, you will see there's a Q&A button on the Zoom bar. If you just click on that button and type in your question, we'll endeavor to get to that question at the end during the Q&A. Finally, the slides for today's presentation will be up on screen. I'll be flicking through them. So presenters, if you could please just refer to the slide you're speaking to so that listeners can also follow who aren't watching the video. And if you aren't watching the video, you can get the slides either on the ASX under the ticker SEC or on the company's website. So with that, I will hand over to Jonathan Trollope, the chairman of the company. Jonathan, over to you.
Thanks very much, Chris, and thanks to you and Amelia at the team at Pinnacle for organizing these webinars for our shareholders, and thank you to Zoom who enabled these things to happen in these unprecedented COVID times. As Chris mentioned, the agenda is pretty straightforward. I will be taking you through the company results for the year and the dividends and what we're doing in terms of the NTA discount, which is obviously a concern to us. Marcus and Matt will take you through the portfolio update and the exciting things which they see in the market at the moment. And after that, you are welcome to ask any questions of any of us. I think it's just worth remembering that SEC, the company, listed in December 2017. So we've been around for just under 3 years. It's been an interesting time. We've had two particular events which I think have marked the past year and a bit. Obviously, the market meltdown in February, March as a result of COVID was an unprecedented and unexpected event, and we're still feeling the effects of that. And secondly, in general terms, in the LIC market in Australia, we've seen a widening of discounts between share price and NTA. So those are two factors we'll come to in more detail. Chris, if we could move to the next slide, please. Thank you very much. This slide was also on the financial results announcement, and it shows what happened during the financial year of 2020. So we started off at the beginning of the year on 1 July 2019 with an NTA of $2.04. The main factors which impacted the NTA at the end of the year, which was $1.73, were primarily the portfolio performance, and you'll see that on the chart in the second bar in the blue, which detracted 25.5 cents from the NTA over that period. So that was the major factor in the fall in the NTA over that period. The other factors which contributed were the payments of dividends, and we paid a 4-cent dividend and a 3-cent dividend, and that's the grey bar, three from the right at the end. Obviously, that's something which is beneficial to shareholders. It's always been an objective of the company to be able to pay a regular stream of dividends, and that was 7 cents during the year. That's obviously not franked. Sorry, that doesn't show the franking effect for shareholders, but shareholders received 7 cents, and then you should gross it up for the franking credit received as well. The other three matters which impacted the NTA were the small amount of tax, 0.4 of 1 cent, the company expenses, 0.6 of 1 cent, and then the buyback. The effect of the buyback over the 12 months was to add 2.3 cents to the NTA of the company. So the buyback was accretive to shareholders. Now, if we could move to the dividend slide, you will see that shows the history of the dividends paid by the company since we started. The total dividends which will have been paid when we get to the payment of the most recent dividend announced, which is 2.5 cents, which is payable on 23 September 2020, will be dividends of, in total, 15.5 cents, which, if you frank that up, if you gross that up, is about 22 cents of value in the hands of shareholders. We declared the final dividend now of 2.5 cents. It is not as high as the previous dividend, but we're very conscious of the need to be able to pay shareholders a continuing stream of dividends. So we erred on the side of prudence and conservatism, and have kept a very healthy profit reserve to be able to pay dividends consistently going forward from now on. Moving along to the initiatives to close the discount to NTA. As I mentioned earlier, the fact that SEC is trading as a discount is not unique to SEC. It's very widespread, especially among smaller cap and LICs and those with a relatively small market capitalization. But nevertheless, the fact that it is widespread is not a cause for complacency, and it's not a cause for satisfaction. The position is unsatisfactory, and the board is very concerned about that and committed to doing what we can to address the situation. Now, if you have the slide there, you will see the various initiatives that we've undertaken listed. Firstly, the on-market buyback. As I mentioned, that has added 2.3 cents to the NTA. We bought back approximately $7.5 million worth of shares, and that coincidentally is about 7.5% of the issued capital of the company. We have another 2.3 million left, which we will utilize on a judicious basis, and that again would be expected to be accretive to shareholders. We did announce in March this year that we would be looking at corporate transactions or acquisitions to see if we could increase the scale of the company, because we believe that that is one of the factors which contributes to the discount. We pursued various corporate initiatives. I personally was very much involved in that process. The conclusion is that we do not believe that there is currently a corporate transaction or acquisition which would be in the interests of SEC shareholders. So that initiative is on pause at the moment. Obviously, we're very focused with Pinnacle, and as Chris mentioned, the Pinnacle distribution team, on shareholder engagement and communication. We've really strived to do what we can to improve that. If shareholders have any ideas on what we should be doing differently, please let us know. We'd be very keen to hear from you. We also have transparency of NTA in response to shareholder feedback. So we now have NTA published on a daily basis, and we're one of the few LICs in Australia, particularly one of this size in the small cap area, which does that. We have pursued and investigated other initiatives. We've looked very closely at some LICs who are converting to open-ended trusts. We do not, as a board, believe that that is in the interests of SEC shareholders. The structure that we have, which is an LIC, has advantages and disadvantages. One of the advantages, as we've seen, is the ability to pay dividends on a regular basis, notwithstanding volatility. And shareholders who buy shares in SEC know that they're buying into a listed investment company. They're not buying into a trust. And it's also very complex and time-consuming to convert. I was having to look at some information on another company that's converting. The scheme implementation deed was 475 pages long, and the costs were horrendous. So we are not looking to convert into a trust. We have also looked at practices both here and elsewhere. Some SEC shareholders may be aware that Antipodes listed investment company, which I happen to chair, recently announced a conditional tender offer to buy back 25% of its shares at the year 5 date if the share price had been trading at a discount of 7.5% during the previous 12 months. We don't, as an SEC board, believe that that is appropriate for SEC at the current time. There are quite a few differences between the two companies. SEC has been around a lot less time than Antipodes. It's a very different size. So if you were buying back 25% of the company, you'd have real issues, I believe, with liquidity and basic size of an LIC. And we're also very hopeful that Marcus and Matt, through their increased performance, will be able to entrust and develop a very loyal and shareholder base, and that of itself will narrow the discount to an acceptable level over time. And in terms of their performance, I'm not sure, I think I mentioned, but it's very encouraging that since the 30 June date, when I presented those financial results, the performance of the manager has been terrific, increased 11% overall in July and August. So the NTA, which was $1.73 at the end of June, was at the end of August $1.92. So that's very encouraging, and I think that's a very good note on which I'll hand over to Marcus and Matt. Thank you.
Excellent. Yeah, thanks, Jonathan. Just on that, yeah, we have seen an improved performance, particularly in that August period where we saw our companies actually report, and they're doing a lot better than most people would think. And they're very inexpensive across most of the portfolio. So, you know, we think there's significant upside from these levels. For whatever reason, there's a lot of speculation and froth at the moment, and that money's going to highly speculative names. But there is some sort of rotation going on now, because you are seeing some very credible results across our portfolio. So, and you've got companies basically being given away at our end of the market. So yeah, we're seeing better times ahead. We do kind of compare it to 2009, 2010, and if you go even further back to that dot-com boom and then bust, and subsequent to that, you saw significant outperformance from value. So we're definitely more value skewed. That's because we do valuations, and we believe that will hold us in good stead going forward. It has been a very torrid time for us, though. I get that all shareholders are feeling similar pain to us, but we believe, and we are a shareholder in SEC, we believe there is significant returns going forward. So I don't want to labour on the historic numbers. They're not bad, they're not good. It has been a torrid time, but things are definitely improving on that front.
I think just to add to that, I mean, sorry, just go back for 1 second. Chris, thank you. Yeah, you know, you know, if you go back and look at the market over the last 12 months, it's been a very unusual circumstance where, strangely, and especially in the really small end of the market, you've had stocks that do not make cash flow materially outperform the stocks that do make cash flow. It's a bit of a topsy-turvy world we're living in at the moment. It's not sustainable in our opinion. If you go back over any longer period of time and look at stocks that don't make cash and compare those stocks that do have cash flows, the ones that make cash flows clearly and logically outperform materially. It's just that we have been in an oddly very speculative market, especially in the small end. You know, very low interest rates and abundant liquidity have driven a lot of people to buy concept ideas We don't own those two stocks in the portfolio. As Matt said, we've got a lot of fundamentally very sound businesses. A lot of them have got net cash balance sheets, make good cash flows, and are extremely cheap. Even after their recent performance, we still feel there's a lot of compelling upside in many of the names we have in the portfolio. Next slide, thanks. So this is the cumulative performance of the portfolio post the fees, the portfolio since inception. And you can see that after a period of outperforming, we had a tough period during March, or February, September, end of February, March, April. And really the main issue there was, even though we have stocks that got good balance sheets and produce good cash flow, we had an exposure to the tourism leisure sector, which got fairly debased by the COVID lockdowns. Some of those names have bounced back pretty hard since then, and some we still have in portfolio that we think offer really attractive valuation upside from here. But the other point is we have a lot of stocks that have recovered on the back of the results recently. We can detail a couple of names there. We've got a couple of examples of stocks we own, but we can go through a couple of the names if there's some Q&A at the end. And we still feel there's a really healthy embedded return, if you like, in many of those names we have in the portfolio. Next slide, thanks.
For those of you who aren't following on screen but are following on your own, we're now on slide 8.
This is just we flagged earlier on that there's been an incredible bounce or over exuberance with some stocks in the marketplace, and this is a chart I've just pulled from Bloomberg. And what it's trying to do is just show you the number of stocks in the market listed in Australia that we feel are notionally expensive. So it just tracks the number of stocks listed here with an EV to sales multiple. That's the total value of the business. So all the shares outstanding, plus any net debt they have, divided by the sales price. And typically, if a company's been around for a long time and is profitable, above 5 or 6 times sales is considered pretty fully priced in most cases, unless you're a very, very high margin business. So anything over 10 is truly very, very highly priced stock indeed. And you can see that over the last couple of years, the number of stocks with an EV to sales multiple in excess of 10 is now at an all-time peak at 200 shares. Obviously, the best way to compare that would be to look at how many shares are on issue, but the number of shares on issue for the last 5 or 6 years hasn't changed dramatically. So there has been an incredible re-rating there, and around about 10% of companies listed on ASX now trade in that with that kind of fairly highly rated multiple. And we think that's reflective of where we are in the cycle. We do believe, to Matt's point earlier on, that valuations count. So everything in our portfolio we do effectively do DCFs on. And we believe there's fundamental value supporting everything we own in the portfolio. In many cases, these stocks here don't have that support, and we just flag to investors we think that's these sort of names are at risk of a correction at some stage.
Next slide, guys. Just on Breville Group, it's a company we followed for a number of years. We've liked it for a number of years. We haven't liked, I guess, the rating on it. We did take a position, I think it was last year in Breville. And we increased that substantially in that March downturn. So we increased that position to it's one of our bigger weights in the portfolio now. The company continues to perform well. It's growing its market share globally. So it's not just an Australian company. It's obviously got a big US business, and it's building into Europe now directly in some of those key markets over there. It also has moved into Asia as well, and the Middle East. So it's a company that's performed well from a very small base in Australia with a great brand and a great quality product. And it's a company that I suppose people wouldn't associate with us owning, but it is one we followed for a long time, and we do like. And you can look at the chart and see the cash flow dynamics of the business and how it's grown its earnings and its cash flow on that left chart. And on the right there, just seeing the returns the company generates on the capital it has. So it's generating nearly 40% return on capital. So it's a fantastic compounding business that we own here. It has got reasonably expensive in recent periods. However, we do believe the long-term outlook for this business is very good. So it's going to have points where it's going to get expensive along the way, and it's going to get cheap at points as well. So we'll look to add to this position when it gets cheap, and probably lighten off if it does get expensive. But it's a company that we do like long-term. So it just gives you an idea of what we're looking for in companies.
Next slide, thanks, Chris. Now, I guess at the other end of the spectrum there is a stock called A2B, which was formerly known as Cab Charge. And it's been a position we've had for a while in the funds, and it's now incredibly debased and incredibly cheap. It's actually one of the stocks we refer to as being quite debased and offering very compelling upside in our view. So, I mean, it's been around for a long period of time. It's gone through a few iterations. I think there's a few misconceptions around the business that have probably seen the share price sell off fairly strongly in the last year or two. The first of those is that the earnings decrease that the stocks had for the last couple of years is driven by disruption from the from the ride-sharing sector, the Ubers of the world. That is frankly not the case. The number of cab trips taken in Australia has been flat to gently growing, even though that you've seen Uber and Didi and these other guys come down and compete in Australia. And they've actually, what they've done is growing the marketplace by adding cars to the road and bringing a different kind of consumer to the marketplace. You see the cash flow for A2B has been strong. It has decreased over the last couple of years as you've seen regulation reduce the take rate that they have from the tap and go and the cabs. But it is one of the leading payment networks in the country, which I think people have forgotten. The returns on the right-hand side there, you can see have started to increase again. The very ably run company has started seeing until obviously COVID impacted short-term volumes, they had seen an increase in the revenue in the first half of this year. We believe that the business is well positioned to resume growth in the medium term. It does have a net cash balance sheet. So one of the things we like about this is it has been cash flow generative for a long period of time. It has a roughly $24 million of net cash. It's got a lot of property valuation in there as well. So they own the head office, which is a good block of land. It also supports the valuation of the company, and it is investing heavily in new technology, not just payments, but for cab dispatch around the world, which it's now licensing into foreign geographies and getting revenue from that marketplace. So very well-run company in our view, strong cash flow position. We do feel it's got a very good position going forward, despite the arrival of Uber and Didi and the other ride-sharing apps. And at the moment, it's trading on very low single-digit EBIT multiples if you take out the cash. So, in our opinion, really appealing stock. Very small market cap. We've got a good position in the fund, which frankly would be hard for our competitors to replicate because the stock isn't that liquid, and we own a pretty material holding in it. So. We think it's got a good long-term future and really well positioned and also very cheaply priced.
Next slide. Just on the top 10 positions, and we disclose this every month, there hasn't been much change. I guess there has been some movement due to share price movements, but we tend to take longer term positions in companies. If you look at the top 10 portfolio that we have there, those companies that reported, they all reported very good numbers across the board. One of them, corporate travel, obviously corporate travel is on the nose at the moment, but it's reduced its cost base substantially. I think its cost base per month was in the $20 million pre-COVID, and now it's down to $10 to $12 million per month. So they've taken significant cost out of the business. Even if corporate travel doesn't revert to where it was before, it doesn't need that mean reversion in full. It only needs partial reversion to get back to its earnings prior. And you have to remember, a lot of its competitors won't be around, so it's going to take market share. So there's some really good companies that have popped up, good balance sheets, as Marcus said before, good cash flow compounders that we're finding opportunities in, and the valuations at the moment are very appealing across the portfolio. So we think we're in good stead. I think the top 10 reflects that. And, we're confident that we can make good money over the next few years in this structure, in this type of product. It's a closed-end fund. That gives us, means we don't have outflows or, we have dividends that we pay, but there's no outflows from clients, which means we can really get in there and make good money over the next few years. So we're very excited by the outlook for the market, whereas I think, a lot of people are quite bearish and cautious. Even in that March period, we were very actively buying names during that period. And whilst we didn't outperform the index during that period, we found some good names that will hold us in good stead going forward. Now, if we can open up to questions, please.
Okay, thanks, gentlemen, for your prepared remarks. We have two questions. The first one from Joanne is quite a nice sort of follow on from where you left your comments off, Matt, which is you showed us a chart that showed how the market cap to sales, number of companies was sort of at an all-time high, showing us a little bit of euphoria in the market. But Joanne's asking the question, the other way around, which is, in your portfolio, can you give us a feel for how attractive you see the valuation in parts of the market that aren't caught up in this euphoria?
Yeah. Well, we can both answer that, but I mean, it's a good question, and I think, I guess we've tried to show that with stocks like CabCharge that are in the portfolio, Joanne. So, it's been a perverse market in the sense that the money's flowed aggressively into some of these speculative names, and I don't want to name all the names, but think of a groovy stock title with no cash flow and a tiny revenue line, and give it an $800 million market cap, and you've got what's going on in some of those microcap names. I mean, that's incredibly dangerous. I mean, it's very unlikely many of these companies will be around in 2 or 3 years with any likely valuations they have. Oddly, people have been selling or had sold some of the names that we owned in order to fund those sort of positions. So, CabCharge or A to B is now got a market cap of 105 million. As I said, it's got 23 million of cash. It has a head office probably worth, I don't want to speculate, but tens of millions at least. And it makes, in a normal year, it'll make EBIT of 20 million. So take out the cash, you're paying about 3 or 4 times normalized EBIT. If you take out the head office, you're probably getting the stock for 1 or 2 times EV to EBIT, which is very, very low on any kind of traditional metrics, and it's an existing sustainable business. I can talk to other names like HT&E, which is a radio business we own that's extremely cheap for a bunch of reasons. Maybe touch on that now to give it some flavour.
Yeah, I don't think people are looking at the parts of the business in HT1. They just look at it as an old radio business. And it does have a radio business in it. I wouldn't call it old because listenership is still growing for that radio business. Obviously, it's had a cyclical headwind in terms of advertising. Revenue's been down in that core business. But what it does own is a business called Soprano. It owns 25% of Soprano. And Soprano has a peer that's listed on the Aussie stock market called Whisper. Soprano makes over $20 million of EBIT a year, so $20 million of cash flow. Whisper makes no money. Whisper's market cap is $500 million. And, if you look at those sort of metrics and look at Soprano and what that 25% stake is worth, Soprano could be worth $1 billion and 25% of it could be worth $250 million. If you look at the market capitalization of HT1, it's probably around 400 million. It's got $100 million of cash in it. It's got the Soprano stake. It's got the radio business and various other assets as well in there. So if you add it all up, the sum of the parts for HT1 is well in excess of the market capitalization at the moment. So it's really hard to rationalize what's going on unless you're in it. We see it every day. We struggle. We shake our heads and say, well, what is going on here? Some of these companies are just so cheap. The good thing about HT1 is they're buying back shares. They've got a good balance sheet and they're converting, I suppose they're creating value by buying back shares. And they are looking at ways to crystallize value in Soprano. Soprano is majority owned by the founder. He is obviously investigating ways to list the business or to crystallize value. So at some point, you're going to get some sort of marker for that business and what it's worth. But HT1 is just unbelievably cheap. And it's just like A to B, HT1 and a plethora of other companies in our portfolio. There's so much value opportunity at the moment, and everyone's playing the casino at the moment, and the casino is, it's on fire. Everyone's rolling the dice and winning on buy now, pay later, fintech, and all this other stuff. But there's some really good companies that we own, which will see the light of day soon, and you'll see significant returns out of them. And we're just starting to see that at the moment with that reporting season, I believe.
Yeah, I mean, I'll say one last comment to that. So to Matt's point, I mean, Class, which is one of the bigger holdings in the fund, would have fallen that category. It would go down to about 10 times EV to EBIT, which is the measure we use for looking at companies. It's now probably on 13, 14 times, had a bit of a bounce. And if you go down the list, we've got things like GR Engineering in there, which again is a very well-run engineering firm. It's got a lot of work with the sort of resurgence in smaller mining companies recently. It's got a net cash balance sheet of about 37 million. If you take it off, you're trading at about 4 to 5 times EBIT again, which, these are very low multiples for very well-run, sustainable businesses. In many cases, the founders or the executives have very meaningful shareholdings in the company, which we like. It aligns their interest with ours or your interests. So I'd say we've got a good smattering of stocks on 4 to 6 times EBIT, some growthier names on sort of 8 to 10, maybe 11 times, all of which are massive discounts to the broader market, and certainly at least they have earnings. So hopefully that gives you a bit of a flavour of where we sit vis-a-vis these expensive names.
Thank you, Jonathan. This question comes from Matthew, directed at you. It says, given the LIC discounts to NTA across the industry, including Spheria, as well as the likely weaker returns from equities given the low interest rate environment, have you considered a change to the management fees to boost shareholder returns and close the NTA discount?
Thanks, Chris, and thank you, Matthew, for the question. The answer is, as a shareholder and as a board, we would love to have management fees as low as possible. The reality is that there is a legal agreement, the management agreement, which is set up when the IPO was put in place, and that regulates the management fee between the company on the one hand and the external manager on the other. So it is not within the power of the chairman, let alone the board of the company, to unilaterally cut or change the management fees or other terms of that agreement. Obviously, if the manager wished to cut its fees, we'd be delighted, but that is not a call for the board. It's disclosed up front. Anybody buying in knows what the management fee is. It's a flat 1% of the assets. There are cheaper products, there are more expensive products, but shareholders need to, take a view as whether they're happy to pay for the value of having Matt and Marcus there manage their money through the company.
Thank you. I think for small cap Australian equities, the fee structure is more or less in line with some sort of industry average. I don't know if you, Matt or Marcus, have any comments on fees?
No, we believe they're in line with market. Obviously, we're under the high water mark at the moment, so there's only a base management fee that's being paid. Do we think that there would be any impact if there was a fee reduction on the discount to NTA? I don't believe so, but that's just my hypothesis.
Yeah, I'll just add one comment, Chris, so that, Matthew, Marcus and Matthew Smith, I've been involved in this industry now for about 6 years. The fees when I started off were about 1.5%, and then the performance fees going up. I think fees are generally coming down. But 1% is certainly in line with market that I've seen, and it's lower than some of the other ones I'm involved with. But again, it's not a choice for the board. It's not something the board can change.
Okay, then our final question, and we're sort of out of time, so it's good timing. It comes from Dominic, who's obviously done some work on your financials, but it's a market-related question to you, Matt and Marcus, which is, you talked about the opportunities you saw in the market during the COVID sell-off, yet Dominic's noticing that your brokerage paid in this financial year was less than half in the prior financial year. So could you comment on the level of activity you've been undertaking in the portfolio, both in terms of on-market and in capital raisings during the year?
Yeah, we'd have to look into that. Off the top of my head, the differences between the periods. Yeah, I mean, we are a long-term investor, so we tend not to churn that much. Definitely in that March period, we were very active buying names. You can see that in the portfolio. There's a number of new names that have popped up, and we did have to sell some other names that held up pretty well. There might have been a reduction in the commission rate that we paid, but we'd have to come back.
There was a bit of reduction in commission rate, I think, but it wouldn't have halved the commission. Wouldn't have halved it. I mean, it also depends on how the traders allocate the trading. If we pay what's called high touch through a broker, we pay a high commission rate. If we go low touch, which is through the pipes, through the technology we have, we pay a much lower rate. So it depends on the mix of that ratio between low touch and high touch. Obviously, capital raisings, there's not always a commission paid on that either. No. So there's some of the capital raisings we took. Market's going through a phase of raising money and sort of end of March, early April into May. That period's sort of broadly played out, I think, and there might be one or two raisings, in the pipeline from companies, but it's almost rotating now into an IPO pipeline. We're starting to see some companies looking to list. So it's moved from sort of broadly from capital raisings to IPO. And the other point we haven't really touched on is that Matt and I are firmly of the view that M&A and corporate activity is likely to re-emerge pretty aggressively in the smaller end, just given these enormous valuation disparities we're seeing. And the fact that they've been so dormant for the last couple of months on the back of COVID. Management teams and PE have generally been sitting on their hands waiting to see where the dust settled. But there's a huge amount of liquidity out there. There's a lot of PE funds sitting on a ton of money that they need to deploy. So we're pretty confident we'll see a resumption in that as well. Should benefit our fund, or should benefit the holdings in SEC as shareholders.
I suppose the other thing is, if your activity was at the bottom of the market, then you would have paid lower brokerage because you would have paid it on a lower market value.
That's correct, Chris. I mean, there was a big downturn in February, March period. So yeah, the actual dollar value would have been a lot lower that we were trading. And also, I believe the first half of the financial year was pretty low volatility for us. So there probably wasn't a lot of commission paid during that period. At the end of the day, we'd prefer to pay less commission than more. That's the benefit obviously to our shareholders.
Okay, well, we're out of time. Thank you very much, shareholders, for dialing into the annual results presentation. You can, as I mentioned at the start, find the slides on the company's website. We will also post a replay of this presentation if you want to watch the replay. So I think all that's left is to thank Spheria Asset Management and thank Jonathan for your time today, and thank you to the shareholders for listening in.
Thank you.
Thanks very much.